Now, if we can just introduce Iain. Iain is head of the UK equity team at Baillie Gifford, and he's also the manager of Baillie Gifford UK Growth, who he co-manages alongside Milena Mileva. I think it's a really interesting time to be talking to Iain about this, as we are actually coming up to the 5th anniversary of Baillie Gifford and Iain and his team running the trust. Obviously, a lot has happened in that time, and I think we'll cover some of that today. But I was looking at the sort of peer group rankings on our website this morning, and obviously, despite the obvious growth headwinds, this trust is the best performing fund in the UK companies sector over the last year. Which sort of kind of raise the question, is sort of growth now on a path to recovery, or are the sort of benefits of innovation pushing through regardless? And maybe is even the UK an interesting sort of place for growth more generally? So hopefully we'll be able to address some of those today. But before we do that, Iain, can you just perhaps sort of give us a few minutes just to perhaps introduce people who have not heard of sort of BG UK before, or those that need a bit of sort of refresh, please?
Sure. Well, good morning, everyone. I mean, the Baillie Gifford UK Growth Trust is just under 260 million market cap trust. It's our best ideas kind of UK portfolio. Milena and I pick about 45 of our best names, and we try to own them over the long term. And you know, one of the things that we think, and you know, there's a common misconception, and I expect not from an audience that's listening to, you know, James, Andrew, and yourself, Matthew, but you know, that actually the UK, you know, stock market is about the UK economy, and because you can get very depressed when you listen to hear some of the things about the UK economy. But the reality is that in our trust, over 60% of the revenues are actually coming from overseas, and actually some of the domestic revenues are from, I think, fantastic businesses, like companies like Howden Kitchens, you know, the trade kitchen company, you know, and it's got a fantastic long-term growth story there. So I think, you know, the UK is a great place to find growth companies. Now, if you move to the next slide, the way we try and invest, you know, from Baillie Gifford, we're growth investors, we're long-term, and we're very much bottom-up driven. So on the left-hand side there, you can see the pie chart of how the UK market is made up. And it's kind of quite striking that if you're just used to the UK, you just take it as granted. But actually, it's pretty unusual internationally to see a market that concentrated, that the FTSE 100, the largest 100 companies are, you know, almost 85% of the market. But on the right-hand side, you can see the Growth Trust, the fund that we're running, and you can see it looks very different to that. You know, we've got much more in outside the largest FTSE companies. And the reason for that, in our view, is very simple, that we follow the growth. We don't think about, you know, is it a FTSE 250 or 100 companies? Is it a growth company on a long-term basis or not? And what we think is that there's a lot of companies, large companies that are very well-known companies, which we just don't own because we don't think the long-term growth story is that attractive. Now, in the short term, or maybe not in the last year, you're kind of kind to point out the short-term performance, but the medium performance has been a bit tricky because not owning things like the oil majors or some of the big pharma companies has not been helpful to us, as there's been a kind of flight away from growth and more into kind of risk-averse kind of companies. But we still think long-term, you want to back the companies that we think are going to have above average growth rates. So we're not going to change our style. And it's kind of interesting that our portfolio characteristics have not changed. And if you go to the next slide, this really kind of tries to summarize some of the points about our stock picks in the portfolio, that what we're looking for is high growth, high quality, good financials, and kind of low debt. And you can see in the portfolio, and this is numbers from taking a couple of months back, that, you know, we've got higher growth in terms of sales growth, we've got better gross margins than average, good earnings cash flow, and also lower net debt, considerably lower net debt than the market. And we want to hold these stocks for a long time. And you can see there that, you know, we've held over 70% of the portfolio for more than 5 years. Now, that can sound occasionally a bit boring, because when Matthew will ask you, what are you up to? And you can say, well, not very much. It's not really kind of exciting. But actually, we think to benefit our client, our shareholders in the long run, our fellow shareholders, Milena and I really believe that you want to pick good companies and try to own them for as long as you can, and not kind of get disheartened, when growth's out of style and the share price doesn't do particularly well. But when fundamentally the business is still doing really well, you want to own it for as long as you can, because in the long run, we think that share prices follow fundamentals. And there's a very good example of that on the next slide, Matthew, where we talk about a company that we've owned in our other portfolios longer than the trust. We've owned it from the trust since from the go. But this is a company, Ashted, the plant hire business. We bought it back in 2010, and we've owned it ever since. And you can see there's been ups and downs, but actually the fundamentals of that plant hire business have been getting stronger, and it's been a great investment. And I'm not saying that every stock in our portfolio could be as strong as this one, but it's a principle of let the fundamentals do the talking for you, rather than me trying to predict what the stock market's going to do over the next 6-12 months, because I have no idea. But what Melina and I have spent a lot of time thinking about is, do we think a business like Ashted or other companies like Offshore Trader or things like that, do we think they have that growth potential over the next 5 years? And if we do, we want to own it, because the longer you own it for that period, the better chance you are to actually capitalize on that share price outperformance. So we just kind of be patient. That's the key thing for us there.
Yeah.
In terms of the portfolio more broadly, and it's going back to this point, Matthew, but whether there are growth opportunities in the UK, and I thought Andrew's kind of comments about the FANG stocks is kind of interesting, because that's always the thing that people worry about in the UK, is that it's all dull. There's nothing really exciting or to invest in. But what we're trying to show here are kind of themes that which are in our portfolio. Now, just to be clear here, we pick stocks and then we kind of said, well, what are the themes, rather than saying, here's a theme, let's buy some stocks to fill the bubble. But what you can see here, that there are lots of interesting areas in the UK, from R&D innovators and data companies like Experian, companies that are kind of exploiting the digital enterprise and so on, or market share gainers. And that's a really important point, because that's another way to get growth. So the point I would say is, if you're willing to be a bottom-up stock picker, there are interesting opportunities in the UK. And I don't know if we want time, Matt, to want to talk about stocks, but I've got 2 or 3 examples on the next couple of slides. So maybe if you want me to talk about them, or happy to take questions, really, just to kind of really bring it to life.
Well, I think we've got a sort of few questions coming in, but I think certainly some stock examples would help bring this to life, whatever you like. Sure. I'm just interested in the process, because you look at something like Ashted, you think of that as, plant hire, sort of what are the barriers to entry. It doesn't feel like a growth business, but sort of clearly it is from your slides. So perhaps we talk through some of these examples. That'd be really helpful.
Yeah, well, I mean, on Ashted itself, the reason why we think it's a growth business, because particularly in America, that's where the bulk of the business is. Historically, people owned assets, construction companies. Unlike the UK, where the penetration rate of hire is much higher than in the UK than in the US, but that is changing. And I think it really started to happen, accelerate after the great financial crisis, when companies couldn't actually get the finance to buy things. They had to hire it. And then they actually realized, this is a lot more convenient to me than actually kind of tying up a lot of capital and spending a lot of cash to buy things. So actually the rental penetration has been going up. So that's what, in the short answer, Matthew, why Ashted we think has done really well, is because there's a growth, there's an underlying market share in the sense of rental has been going up quite significantly. Now, the way we think about growth more broadly, and there's 3 stocks I can briefly talk about, Matthew. And it's really trying to encapsulate what types of growth are we looking for. And I would say we're very growth agnostic. But there's one type of growth, which is kind of steady growth. And Softcat is a business that we bought in the last financial year, which I think is really interesting. And what it does, it provides IT solutions and services to businesses and the public sector. In plain English, for example, Baillie Gifford, for example, is a customer of Softcat. If I need a new laptop, my IT team gets Softcat to get it from Dell. They get the basic stuff set up. So when I come down to pick up my new laptop, it's a pretty pain-free and hassle-free kind of experience for me. Now, audience people might say, well, God, that's not exactly rocket science, is it? But you would be surprised. And when we spoke to our company, we'd actually replaced our previous company with Softcat. And the account kind of person that was dealing with them said, look, I know it sounds really simple, but when we ask for stuff, they deliver it on time and in the exact configuration that we ask them for. And that doesn't happen a lot. And it didn't happen with our previous company. And it's a big pain in the ass because people like me turn up and it's not the thing I'm looking for. And I get kind of, because I'm a fund manager, I have a hissy fit and things like that. And you know, and then I storm off and I come back in a couple of days' time. Obviously, hopefully I don't do that. But you know, it's a bit of a waste of time. Whereas, you know, companies like that are doing simple things, but it's not easy. And people like that. And then when companies say, look, actually, I need to work on my digital, I need to kind of upgrade there, but I don't quite know how to do that. People like Softcat are a great, they can help you, they can give you the kit, they can give you advice and service and to do that. And this is a quietly growing business because companies are always perennially having to upgrade their IT. They're just, you know, whether people need a new iPad or a new kind of laptop or whatever, but also the fact that things like digital, that companies are having to spend more money on these areas, and they want people that they trust to do it and to do it with them. So that's kind of Softcat. So it's a very there's a problem there. They have a good solution, and the customers love them. So that's the first one. The next slide kind of talks about a very different type of growth, and that's probably one that a lot of people understand Baillie Gifford is kind of, you know, well known for, which is disruptive growth. But there are UK companies that are disruptive growth businesses, and this is Wise, which or TransferWise. You may have heard of that, and I don't know, Matthew, if you use it, but the question is, you know, if you're going abroad or if you're going to make a bigger purchase abroad, if you go to your banks, you don't get the best rate.
No.
And what Wise have done is basically create a system and a kind of network where basically you will save money pretty much every time you go abroad using the, you know, and you want to get foreign currency or you want to make a purchase. If you use the Wise platform, and this is no plug, I use it, but you know, I think it's you win, I win, because basically Wise gets bigger, sort of thing. And it's interesting because they are getting bigger, but they're still a small part of the market. Now, the banks dominate it. The banks never want you to know how much they make from this, because if you look at a bank kind of P&L or a presentation, they'll never talk about it. But that's usually a good reason why they don't, because they make so much money from it. And what was really interesting, Matthew, was last year we had one of the big banks in, one of the finance director, and we ended up on talking about Wise or foreign exchange, and I'm not going to mention who it was, I don't want to embarrass them. Basically, they were saying, well, yeah, well, look, we've got a much bigger kind of pool of that, and you know, if we wanted to, we could squash them, and you know, we could do it. And then we said, well, you know, when we asked what I call the daft laddie question, which up in Scotland is kind of quite a common thing, which is this, you know, sort of like, well, and I said, well, why don't you do it? And the guy was just kind of like stunned and nonplussed, and he kind of started muttering, well, actually, well, you know, our systems and blah blah blah. And the truth is that it's true that the banks do have a big market share, but as we all know, the banks have their IT systems are an absolute disaster here. They don't speak to each other. There are lots of legacy systems, and even if they wanted to do it, they'd have to get so much internal you know, buy-in to actually do it. And to me, it's almost a bit like, you know, these kind of, you know, entrepreneurs, you know, people trying to teach entrepreneurship, and it's some guy that's from the public sector who's never actually done it in his life, but it's kind of talking about it. It doesn't feel authentic, it doesn't feel real. No. Whereas Wise are genuinely, you know, entrepreneurs, and they can do it. So that's a really interesting kind of, you know, disruptive growth business. And then the last one, Matthew, is it's kind of what we call blue sky, and it's our only unlisted investment in the trust. It's a very small investment, less, you know, it's less than 0.5% of the fund. It's a company called Wayve. If you can move on to that slide if you can, and what that does. I think we're still on Wise. I don't know if you can move on to the next slide. Here we go. Yeah, perfect. Thanks. And what it does is has a different approach to autonomous driving. Now, you've probably heard of lots of American companies doing autonomous driving solutions. You know, you can see people doing it in California and so on, but they've not cracked it yet. And it's interesting because the reason why the way they've generally tried to do it, this is a very simplistic way, but you know, bear with me. But what they've tried to do essentially is create rules. So it's almost a sense of, you know, the car is driving along, a van comes out from the left-hand side, you know, you should brake type thing. That's the kind of, or, you know, somebody steps out in front of it, you know, you brake. But the problem is, as you can start to think of, when you start thinking about it, there's so many solutions and so many different things that could happen, that the rules then become incredibly complicated. And do they always, you know, capture every possibility that's coming? Probably not. Now, what Wayve have done is look at it in a different way, and what they do is almost kind of it's almost using AI. And I know it's kind of it's a thing of the moment. I'm sure everyone's talked about it, but they were doing this a while back, saying like, why can't we use AI, deep learning, to train the system to kind of get better? So it learns itself rather than you have to feed it in rules, because it isn't that a way that it'll learn much more quickly. And the way they do that is they collect data. So they have a tie-up with Ocado and a couple of other kind of companies where they have on Ocado, they have the kind of a camera, and they collect the data and they feed that data into the network, and the network kind of processes that and learns on it and goes, well, that's what the driver did, I understand, things like that. And the system kind of gets better. And it's very interesting that viewers might be interested, if you go to Bill Gates' blog, you know, the founder of Microsoft, he actually was driven in a Wayve car not that long ago, and he talks about it. It's a really good summary of what actually this is all about. You also have the memorable image of Bill Gates stopping and going to get fish and chips in London, and wolfing down with fish and chips, which I never thought I'd ever see in my life, but and he enjoyed it. So, you know, that's Bill Gates. You know, he likes autonomous vehicles like Wayve. He also likes fish and chips. But yeah, you learn something every day, as they say. But
absolutely.
So, anyways, that's kind of a few examples of things that we look at. So we're very style agnostic in terms of growth, as long as it's growth, whether it's steady growth, disruptive growth, or potentially blue sky growth. And you can get all of them in the UK. That's the kind of the bottom line. So end of message, it's a sunny day outside. We're still remaining very kind of upbeat about the prospects in the UK. It is a good hunting ground for investors. It's still, we're starting to see people look at the fundamentals again. There was a bit of a kind of, with rates going up, people were just not interested in growth. I think that might start changing. I don't know. But what I am confident about is that we have a portfolio of stocks which have faster growth potential than the market, and we think we will get rewarded for that at some point.
Excellent. Okay, let's just have a quick look at some of the questions that we've got here. Okay, we've just got a quick question. Could you briefly talk us through your stock selection process and how much emphasis is put on valuation?
Yeah, I mean, we spend a lot of time thinking about companies. We have a team of 7 of us, and sometimes the research can take up to a year, doing more follow-up work, trying to get to know the company. We write a report. We have what we call a devil's advocate piece to kind of challenge it. We then have an agenda that we take from that, and we kind of then discuss the kind of points. We're trying to go through it systematically. One of the points is valuation. It is a very important point. But I suspect where we're different than thinking about valuation is we're trying to think about where that business will be in 5 years' time, rather than, the PE over this year is a bit more than the market, because our kind of contention is that there are a lot of companies in the UK, including our portfolio at the moment, that look more expensive than the market on a short-term basis. But we think because they will compound their growth and cash flows at a faster rate over the next 5 years, that will be actually looking very attractive rather than looking expensive, if that makes sense.
Yeah, absolutely. I mean, with your process, do you end up with perhaps a sort of batch of companies waiting in the wings, as it were?
Yeah,
to things you're perhaps ready to act on if the conditions are right?
We have very low portfolio turnover, Matthew. Yep. It's about 5% per annum.
Yep.
So I would say the competition from capital is very high.
Yep.
So one of the biggest challenges I think in fund management is not to be a busy fool. by,
Yeah.
you've got an industry you've got a team, we're writing lots of reports, and you end up you feel you've got to do something. Whereas actually, I think part of my job, I kind of quote a famous politician saying this in the past, part of my job occasionally is to go around stirring up apathy. That you don't want to kind of do too much, because if you really believe in your portfolio, and this is the key points, I'm not apathetic about my portfolio. We think about that a lot. But I'm not going to change it just for the sake of here's what I call the shiny new toys arrived.
Yeah.
Isn't that better than old Teddy that's always served you well? You've got to think about it. If old Teddy you think is going to be a better bet in the next 5 years, you don't want to churn it, even though it might give a nice story to yourself or James. Actually, it doesn't serve your shareholders well, in my view.
No, that makes a lot of sense. So, what else have we got here? There's just a question on the benchmark. If it's the FTSE, is that right?
Yes,
it is. The question is, do you think there's a suitable comparator, being as you only have a half weight?
Well, it can go both ways for you. It's fine when it works. It's not so comfortable as it hasn't been the last, on a 3-year number, to be blunt. But what we start with is we don't worry what's in the index. What we worry about is in our portfolio. And you've got to have a benchmark, which, the FTSE All Shares is the widest possible thing. That does mean, to me, to outperform, you've got to be different from the market. And the downside of that is that sometimes you're going to be out of tune and it's going to look pretty horrible, in my view. But to me, as long as you're not obsessed about the index and your little positions, rather than saying, what Melina and I are obsessed about is our portfolio and our stocks and their prospects. And it's not to get spooked by that. Now, I think it's really useful. I think I should always say that, one of the great advantages of an investment trust is having a board that is there to kind of to challenge, but also to support you on these points. And one of the kind of key points we've been talking about is to make sure that we're not drifting away from what we're trying to do. I think style drift is the biggest killer of fund managers. It's always very disappointing. I'm sure you guys have talked about this when people, you say you thought you were going to do something and you do something completely different because you're worried about performance, where we have said, look, we are growth investors. We know that points that's not going to be out of value, but we're not going to stray from that. So we may get stock picks wrong, but we're not going to suddenly drift into buying companies that just don't really fit into our growth potential or growth horizon, as it were.
No, absolutely, makes a lot of sense. We've got a sort of question here on the sort of allocation to private assets. Now, we've already talked about Wayve, which I think was the first private investment for the sort of fund, full stop. And it just says, obviously, I can see that you can invest up to 10% of the fund in private assets. It says, how much do you have currently? Well, that obviously would be the allocation Wayve, but more importantly, do you see this changing? Now, I'm guessing, obviously, there's been a lot of talk about, companies staying private for longer, etc. Is this something you see that perhaps will be necessary because that may just be where the best opportunities are? Do you sort of have a view on that at all?
Yeah, look, what we've always said, your view is correct. We can go up to 10%. We're currently about, I don't know, it's 0.3 or something is in Wayve. It's a very small.
Plenty of headroom then.
Yeah. We haven't added to that because we haven't found anything yet that's taken our fancy. And we've always said that we're not going to, it wasn't that, we're just desperate, we're going to do stuff. It's very much about, do we think it's something that is additive to the portfolio?
Yeah.
And probably something that you can't find that is in the quoted area. And Wave's a good example of that. But so far we haven't seen anything. And I should say we also draw on the expertise of our private companies team at Baillie Gifford as well. So it's not that we're trying to get too distracted by trying to find things ourselves. We're working with our colleagues. We've looked at a few things, but we haven't progressed them. And again, it comes back to that point, whether it's listed or unlisted, there's a high barrier, there's a high kind of competition for capital, high barrier for somebody to come into our portfolio. But do I think it will change? It could, but if it doesn't, it doesn't mean that don't read anything into it. It's not just about, is the stock good enough to get into the portfolio? That's the way I think about it.
Yeah. I suppose in that regard, just sort of comparing the quoted and the unquoted, is the investment process substantially the same? I assume it is. Are there any critical differences or?
I think there are some differences, but in terms of business analysis, there's no change at all. But sometimes the governance thing, you have to kind of, they're a little bit strange for a listed investor. But again, that's a great thing about having the private companies team, that we work together. They kind of, to some extent, hold our hand about some of the kind of things that we're not so used to, you know, some of the things like NDAs and things like that, non-disclosure agreements and stuff that you have to kind of sign and things like that. But, you know, the thing we have to be careful about, and we have been careful about, is it is a bit more time consuming compared to, say, a listed investment. But as long as you kind of keep that in check and you know that point, then it's not a problem.
Yeah, absolutely. I mean, are there any sort of considerations? Because obviously with a unquoted company, is there a sort of higher threshold? Because with a listed company, if there's a problem, you can, hopefully if the market hasn't moved against you, sell it. But obviously that's a bit tougher with a private investment, isn't it?
Yeah, I mean, I think it goes back to what I said earlier, Matthew, that you've got to say, why is it different to something? Because if it's a me too, then why wouldn't you just buy the listed one? If they're the same quality business.
Absolutely. Yeah.
So I think, you know, we're stock pickers ultimately. We want to invest in great businesses in the trust for our shareholders, and that's the thing that I'm looking for. Is it a great business or not? That's the kind of really the key thing. And you know, I think what we're trying to say is we are open-minded about if it's something, a business that happens to be, you know, kind of unquoted. But you know, look, if I'm honest, at the moment, more of our attention has been drawn to, you know, I'm sure you're aware, there's all this bit of a hoo-ha about the crisis in the UK and listing arrangements. Should we be changing that? Should we be changing, you know, paying, you know, US style pay to chief executives, stuff like that, which, you know, I've got views on, which you might imagine I'm not that keen on, sort of thing. But that type of thing is on my mind more, is that there's always a bit of a panic and people want to look to lower our standards. When actually, I don't think that's the big problem. I think the big problem is we've allowed the kind of the gold plating on our governance and our reporting. I mean, I'm sure, you know, Andrew, or, you know, yourself or James could say that, you know, even reading an investment trust set of accounts now compared to even 5 or 10 years ago, I mean, they're much bigger. Doesn't actually help the reader of the accounts actually do anything. There's an industry that's grown up gold plating stuff, which, dare I say it, and you know, I'll probably be lynched for saying this by my colleague, you know, nobody reads. There's a lot of stuff there. There's nothing to do with, you know, that's helpful. And I think, to my mind, if I had a magic wand, Matthew, I would be saying, look, let's go back to sticking with principles. We want well-run businesses that are open and communicative to their shareholders, but we don't need all this verbiage of garbage that nobody reads, that it's just kind of, you know, box ticking, because that's the problem for executives. That's the thing I hear that's a big problem, is boards are spending more and more time getting bogged down in box ticking because they have to do that. And you know, that's the problem for me. Sorry, I'm ranting here on a Friday, spoiling everybody's day.
No, it's fine. I have a sort of tendency to agree. I think it's probably only me, James, and Andrew that read them. So
But as I say, you know, the question I would have is how much of that is useful and how much of it is not useful. And I think there are obviously lots of stuff in the investment trust or any accounts that are really useful, but there's so much stuff now, you just think, who reads that?
No, it's a sort of fair question. I mean, in that regard, is there anything else you think that we should be doing to make the sort of UK market more attractive as a destination?
Well, the thing I would say is let's not pretend that there's some magic bullet. That, you know, if we lower our standards, you know, listing standards, or don't give shareholders the right to vote on class 1 transactions, that somehow everything is good. I think, again, go back to the reason why we've introduced a lot of these shareholder protection, and I think the UK is really good for that. We shouldn't undermine that, is to stop abuses, and we have seen abuses. But what I think the bigger problem has been is there's been abuses. People want to kind of, you know, people say something must be done. And then we end up with more and more rules and kind of things, rather than say, look, we have principles, we should be sticking to the principles, but it doesn't mean, you know, that you are, you know, and James and Andrew have to wade through 20 pages of governance stuff about investment trust. You know, you should be able to, you know, in my view, summarize that. And I'm probably my investment trust colleague, Baillie Gifford, would want to strangle me for saying that. But, you know, but I mean, it should be able to, it's not rocket science, a lot of this stuff. It's difficult practice, but we don't need to have so much pages and pages of box ticking to basically, you kind of, to be a well-run business. I mean, the thing I always remember from one of my old partners when I was training said, when you look at most frauds, they always had perfect corporate governance on paper.
Yes. Yes.
Yeah, and unfortunately, as we all know, that's probably true. So actually, just saying you got all the gold-plated stuff doesn't mean it actually happens in practice.
Yeah.
Good businesses do good stuff because they know it's the right thing to do, rather than because they're ticking a box. And I think that's the thing we've got to get back to. Make it more simple. Our tax laws are crazy. There's so much stuff there.
Very
We need to
complicated.
simplify it. I mean, it's interesting, Nigel Lawson, for some of the older listeners, the former chancellor. I mean, one of the things I admired about him was, he took a real axe to the tax law, capital gains tax and stuff in his time. And then what's happened subsequently is all gone back again. It's grown into this
been rebuilt.
thing. Yeah. And I think that's the type of thing we should be trying to get back to, make the UK an attractive area for people to invest in. And that means actually doing the hard stuff, make it more simple, get rid of the red tape, simplify it, make it an attractive place to do business. That'd be my that's the Iain McCombie party anyway, view anyway.
Yeah.
So.
No, I think that makes a lot of sense. So we've got our sort of investment trust forum later in the year. If your compliance people allow you, I think you would come and talk to us. Got a couple more minutes. I think just time for a few more questions. Somebody sort of picked up on the 5% turnover that you mentioned, and the sort of question is this lower than normal? In my head, you sort of talk of a 5-year sort of horizon, but if sort of 5% per annum, that suggests you're sort of holding these things on average for sort of 20 years, which is definitely a long-term view.
Yeah, I mean, first to say is it's not a fetish by the number. If we went up, it means somehow we're changing. But I think the thing, particularly for any shareholders who've been listening and have been a bit, disappointed with performance, we are, as a fellow shareholder, I've been disappointed. But the thing I think is really important is you don't react if you think the fundamentals of the companies are still good. And what we think has really been happening, and when we looked at performance attribution and things like that, it's not like we've made lots of really bad stock investments, we think, because they haven't gone wrong. It's the fact that they've fallen out of favor.
Yeah.
The growth, as you hinted earlier, that's been a really big headwind for us. And also the fact that the UK market's got a lot of what I call value stocks in it. Again, has been, it's almost that kind of perfect storm, as it were, for us as growth investors. But the thing that in my experience, and I've been at Baillie Gifford since 94, is I've been through performance cycles, and I think the key thing is not to panic, to stick to what you believe and what you're doing. Keep looking at the stocks. Now, you need to make a change, you make the change. But if you believe in the company and you think it's just out of favor of the market, don't sell it. Don't get into that. And that's why, in a way, we haven't, and I think that's kind of the reassuring point. We really believe in this portfolio and our process. That's why the portfolio turnover is low at the moment, because we think, why you want to sell a company that's underperforming when it's still operationally is outperforming? Doesn't make any sense to me. And it's having that confidence that Milena and I think, having the process, trusting the process, and just saying, look, at some point we think we'll get recognized for that. Of course, we could be wrong, but that's a start that's kind of for Baillie Gifford, that we've been doing that for 25 plus years in our pension funds, and that's why we've got decent record, is because we know that's the key thing. It's very easy to drift away from that, but actually that's the wrong thing to do for shareholders.
Yeah, no, that makes absolute sense. I mean, just in relation to that, am I correct? I mean, you have sort of been over the portfolio, you've been out, you've been speaking to companies. I mean, the message, despite the sort of headwinds for growth, the sort of general thing is that all is well. Is that right?
Yeah, I mean, it's interesting. I mean, 6 months ago, everyone was getting like, it's going to be Armageddon this year, just after the trust kind of debacle.
Yeah.
And it's not really quite been as bad as that. Now, I'm not sure that, obviously people know it's going to be a bit tougher. I think the consumer is going to get tougher still, as a lot of these fixed rate mortgages and so on come off, and rates going up again. That's going to cause a little bit of problem. But it's not been quite as bad as people had thought. And that's the sort of thing of why we are not, GDP guessers, because we have no idea what's going to happen. But equally, we think that the market often just fixates too much on the near term and doesn't think about the long term. And that's why, I take something like Howden's Kitchen as a great example. It's clearly there's a cyclicality to that business, but long term, people still want to have new kitchens. And it might not be this year, but it might be next year. But it won't be put off forever. But there are other factors that are going on. I mean, I think it's a fantastic business. I was visiting it last week down at their manufacturing facility, and it's an amazing facility. You know, it's world class in what they do there. And it's really important to understand that is one reason why they're really good. They've got these depots, 800 depots around the UK, which is what a lot of people might know about them. But they also have this amazing manufacturing capacity, which gives them that competitive advantage. And it's that trying to understand these points, why we think that's going to be a long-term winner. And it's nothing to do what's going to happen in the next 6-12 months. I don't really care so much about that because it's got a very strong balance sheet. It's got net cash. It's going to sail through that tough time if it comes. But what I also would note is that every time they've had tough trading for the market, they have come out of it stronger because they are a fundamentally better business than a lot of their competitors, in my view. And the numbers bring that out because they're now 20-25% of the market, which is pretty remarkable from something that was only founded in the 80s.
Yeah, that is quite substantial. Okay, we've gone 5 past now. So I'm sort of conscious that we've overrun slightly, but I think it's been really, really worthwhile. Hopefully we'll be able to sort of get you back in another year or so and get another update. But sort of really thanks for talking us through the trust today.
Well, thanks. Sorry for running over everyone, but
no, not at all. That's on me. Okay, if we just talk about, we've got a few more things lined up. So next week, I think James is going to be back. He will be talking to James Tom of Aberdeen New Dawn. And then we've got sort of Matthew Silleberry, Emerging Opportunities, the sort of week after that, followed by Triple Point Energy Transition, and then Miton UK Microcap. As you can see, we're pretty much now booked up to the end of July. So obviously sort of stay tuned for a lot more exciting stuff here. And I think, have we got a disclaimer at the end here? Right, brilliant. Thanks very much, and see you next week. Bye.